Paul, my question on gold has been what incremental information needs to hit the market to sustain its move higher? Today, maybe we got an answer that, I don't know, kind of nothing. I didn't see much. What's going on here?
No, you're right. There wasn't much. And, you know, I was thinking about it on the way over here because we were kind of scrolling through some of the gold markets as well as some of the stocks. And I'm wondering if it's not so much the dollar, because it's been kind of the anti-dollar trade, but the dollar's been creeping up here. Inflation's not an issue, so it's not inflation. And I'm wondering if it's really kind of confidence in the U.S. government or in central banks around the world that they're going to be able to pull this off and continue to maintain long-term growth, or has central banks lost their way at this point? And that tends to be, you know, kind of the dark corners of the gold market, if you will. But that's something that we've been seeing a little bit more of over the last 3-4 months or so, as gold has kind of ticked up here. It really hasn't been a lot of macro news, hasn't been a lot of dollar move either, but it's been a little bit more in confidence in, if you will, governments around the world.
Maybe there's a sign that markets are truly still obsessed with Fed when they pay attention to the beige book, because you don't hear that one as a market catalyst very often, Paul. All of a sudden, everybody today's talking beige book. I mean, did you look at this? Was there anything new that we didn't already hear from all the Fed governors about the U.S. economy?
No, not at all. You know, and certainly Powell has taken all of the fun out of the next Fed meeting here with the 25 basis point hike that we're going to see at the end of July. So then it becomes, what's next? To go back to your gold question, what's next for the Federal Reserve? The economic data has been mixed. Retail sales pretty good. The consumer's in good shape. The industrial side has been on its back for a little while. So we're going to be looking, I think, more at the employment data again, yet and still in August and September, and the inflation data. And we're not seeing a lot of inflation. So it's going to be a question for the Fed as to what do they do next? Are they doing one and then they sit on their hands for the rest of the year? Or do they go along with what the markets are hoping for, at least 2 more cuts here?
All right. So, Paul, now the 50 basis point is basically in play. An impossible question to answer, but I got to ask it anyway, which is, do we know how markets and risk assets feel about a 50 basis point cut? I think the last 6 months told us very clearly 25 is what they wanted. It felt comfortable. It doesn't signal too many alarm bells about the economy. But if they come out and do a double whammy, how do you want to be? What do you want to be holding that day?
Cash. You know, when you look at that, and this is one of the things that we've kind of struggled with at this point, is why is the Fed cutting at this point? We're below 4% unemployment. We've got decent economic growth. Again, it's okay. Inflation's not an issue either. So again, why are we cutting here? And a 50 basis point cut means something is really not going well in the economy. It's something more than just an insurance cut. And I think that's going to spook the markets. As much as there was some indication that we would see 50, I think that would really spook the markets, because there's something else going on that we're not aware of at this point, and things may not be all that good, and that's going to translate through to earnings in the second half of the year. We could see stocks straight off there.
Okay. Now, the last thing I'll follow up with that is a lot of folks would say, Paul, you're crazy to not think a double barrel blast from the Fed is not going to jack up stocks to the moon. I mean, we know that they like the dovish policy. We're at 20 times earnings. We're getting pretty high again. But, a year and a half ago, the market got to 23 times. So if suddenly the Fed does that type of move, what option do investors have but then to just own equities and own risk?
You know, and that's certainly been the argument the last 10 years with the zero interest rate environment. You go back to what a corporation's doing and borrowing money and buying back stock. And we may very well be back to that point. The issue is, I think, going to be a little bit bigger in the fact that we don't have Europe doing well. We don't have China doing well. China is slowing down, thank you to the tariffs. So the economic backdrop globally is a lot different, I think, than it's been in the last 10 years, where we've been coming out of and improving from the Great Recession. Now we're 10 years on. I'm not so sure that we're now looking at a much different situation for the next 3 to 5 years than what we saw in the last 3 to 5 years. So I think much of the juice has been squeezed out of the orange at this point. I'm not sure there's as much left in their trick bag, and that's part of the reason why I think the market's maybe more spooked than pleasantly surprised by a 50 basis point cut.